Well, let's talk about those inflation numbers with Eric Theoret. He's global macro strategist at Manulife Investment Management. Eric, what kind of conversation do we have now about the Bank of Canada now that April inflation numbers on both a headline basis and a core basis, on both an annual basis and a monthly basis, have come in stronger than expected?
Yeah, absolutely. I think this is keeping in line with the theme that we've seen in terms of inflation and the central bank relationship lately, in that we've seen a persistence of inflation, obviously in terms of level being much elevated relative to target, but also in terms of the struggles that central banks are really having to get inflation back down to their 2% targets. I think the Bank of Canada and Canada generally in terms of its inflation numbers have been looking a bit better in terms of where they needed to be. We had inflation coming down, I think, quite a bit more aggressively relative to some of our peer economies. But that being said, today's surprise definitely keeps that bias from a central bank policymaker perspective to the top side. So really needing to maintain that hawkish bias in order to convince markets and obviously market participants and keep policy tight enough to really achieve that price stability target.
A hawkish bias would be reflected in the language that the Bank of Canada uses when it speaks to Canadians, correct?
Yes, exactly. So really making sure that consumers, businesses, and the economy as a whole understands that the bias for interest rates is still to the upside, despite, I think, what many have interpreted as somewhat of an implied pause for both the Bank of Canada as well as the Fed.
Okay, let me tell viewers and yourself, Eric, where the increases came from in the CPI index in April. Again, on an all items basis, prices, the CPI index, consumer price index, rose by 0.7%. Excluding food and energy, it was 0.5%. So there was a meaningful advance even with food and energy excluded. Shelter costs rose by 0.6%. Clothing and footwear rose by 0.7%. Transportation rose by 1.5%. Gasoline, which has been a source of which has pressured the CPI down in recent months. Gasoline prices moved up in a big way. They were 6.3% higher in April than they were in March. Working my way down the table, on an annualized basis, again, on an all items basis, the change was 4.4%. Gasoline on an annualized basis actually came down 7.7%. Any surprises there, Eric?
Well, I think, what we need to keep in mind, especially as it relates to inflation, is just the narrative that we've had over the past year. Obviously, food and energy prices have varied widely as a result of geopolitical developments and, the kind of knock-on effects that flowed out of those events. And now that we've annualized those, I think, there is an impact in the sense that, the downdraft that we would have expected in terms of food energy prices, that has largely been annualized. And so going forward, we obviously have a focus on the kind of more persistent core measures of inflation. But I think even headline now is something that we're going to have to keep in mind a bit more, in the sense that, again, with that downdraft of the annualization of the spike in oil prices, that has largely played out. And so we are now, again, looking at an energy and food price energy picture that is a bit different than what we've had over the past 6 to 12 months. What
about mortgage costs? There was some of your peers at TD Securities were speculating or forecasting is a better word, that mortgage costs would be a source of price increase in the index.
Yes, absolutely. I mean, this is a theme that we've had both in Canada and, of course, across the border in the U.S., mortgage prices being a very big component of the inflation narrative, and one that is impacting consumers, especially as they continue to struggle to these interest rate increases that really are starting to filter into the consumer and starting to impact their spending patterns.
You said in a recent report that Canada has showed greater improvement in reducing inflation and also had achieved a clear decline in the pace of core inflation than the U.S. and the U.K. Do today's increases change that narrative?
Yeah, I think in terms of the global picture, Canada, I think, still looks a bit better, probably closer to home than most other major central banks. But at the same time, I think all central banks, the Bank of Canada included, are really struggling with getting inflation back to target. And so while on a relative basis, Canada might look a bit better than the US or the UK and far better than Europe, it still has a lot of work to do.
We often hear that that perhaps the easiest work has been done in reducing inflation. It may be more difficult to get from roughly 4 down to 2 than it was to get from 8 down to 4.
Yeah, I think, again, central banks, I think, have reached or are getting very much close to reaching this kind of peak or terminal rate, that cruising altitude at which they'll keep interest rates. But I think the challenge with central banks and the markets, obviously, in terms of the pricing that it's reflected, is that the market is really starting to price in an aggressive amount of easing on the backside of this kind of peak terminal rate. And I think that's the phase that we're in now in terms of the interplay between central banks and markets, and central bank policymakers really having to push back on these expectations for easing because we're in a very different situation that we would have found ourselves in the past. And so elevated inflation means that central banks just can't come in to ease in the way that they have in the past, because they still have quite a lot of work to do in getting inflation back to target.
Okay, the Bank of Canada will next make a policy announcement on June the 7th. What is your call? What will the bank do on that day?
Well, I think in terms of the Bank of Canada, they seem to be very comfortable with where they are. Obviously, they've maintained a hawkish bias. And so I think the question is really, in terms of the data that come out ahead of that meeting, we've had, again, today's inflation numbers, recent employment data have been far stronger than expected. So as much as there is, I think, this expectation for a continued pause, I would say in terms of the risk as well, in terms of the way the data have shaken out, the risk would be to the upside. And so I think it would be a neutral with the risk of a hawkish surprise.